Hello everyone, a very warm welcome to all of our guests. Thank you for joining us today for what I hope you find is an informative session. My name is Paul Stark and I'm the National Manager for SMSF's superannuation and investments at BT. Before we get underway today, I would like to acknowledge that this webcast is being held on the traditional lands of the Gadigal people of the Eora Nation and pay my respects to elders both past and present. It is also important to state up front that today's discussion is general in nature and does not take into account anyone's personal circumstances or financial objectives. We're webcasting today from a large, relatively empty auditorium in Sydney. We would have liked to have seen you in person, but a positive of webinar technology is that we're able to reach many more people. For those of you who are BT customers, thank you for your custom. For those of you who would like to find out more about BT's products and services, we would be very happy to assist you. At BT, we aim to provide products and solutions that help customers prepare for their best financial future. A number of these products and solutions are supported by our Panorama platform. Panorama is a digital investment platform available to both self-directed customers and via financial advisors. It supports various entities, including individuals, SMSFs, trusts, and companies. Panorama provides easy and convenient access to a wide range of investments to help you manage and grow your wealth. It also has a range of great features. This includes an award-winning mobile app, digital document library, investment research, up-to-date valuations, performance and tax reporting, market-first ESG ratings, all in one spot. At BT, we also believe it's essential to share insights to help you. Today, we have Besa Deda, St.George Chief Economist, to provide an economic update on what the road to recovery may look like in 2021 and beyond. Following Besa's update, wealth specialist Melissa Darmawan will facilitate a discussion with two fund managers whose funds are available via the Panorama platform. The fund managers are Anthony Doyle, cross-asset specialist at Fidelity, and Chris Adams, portfolio specialist from Pendal. I'm sure both will offer some really valuable insights. There is time available at the end of the session for Q&A, so I would encourage you to ask your question by going to slido.com and entering the code #BT2020. With that, I would now like to hand over to Besa.
Good morning and thank you so much for joining me today. My objective today is to give you an idea of the shape of the economic outlook, the economic recovery amid COVID-19 and beyond. I'm going to start off with the world economy. The world economy clearly is facing something it has never seen before for a very long time. In fact, the IMF, who are clearly the best forecasters of world economic activity, are anticipating that GDP will decline by nearly 5% across the world, which would be the worst outcome since the Great Depression. The World Bank has put out a study that shows estimates of GDP in per capita terms. That also shows a pretty hefty decline for this calendar year, one of the worst since the Great Depression. But interestingly, also in this study, it tells us that the number of recessions around the world is the most highly synchronised since the 1870s. And I think that really talks to the key problem that the world today is facing with this pandemic. Many economies around the world, particularly the major economies, are coming out of the lockdown. And so economic indicators are capturing what is happening as these economies come out of lockdown. And these charts that I've got up at the moment do show forward-looking indicators of services activity and also manufacturing activity. And it's quite clear that many major economies around the world are seeing a recovery underway at the moment. In particular, a standout is China, which went into the pandemic first and came out of the pandemic first, and it is seeing a V-shaped recovery in many of its indicators. However, other major economies around the world are still seeing, I think, quite a fragile and nascent economic recovery. These forward-looking indicators are yet to capture some of the second waves and clusters that we're seeing emerge, particularly in some of the European countries that are starting to end, I guess, European summer and enter into winter. Now, if we come at home, so bringing it at home, just a short time ago, the Australian Bureau of Statistics released the national accounts data, which showed what happened to GDP in the second quarter. And of course, GDP measures the pace of economic activity. And it showed a 7% decline in the June quarter, which was in line with our long-held expectations. And that's the biggest quarterly decline since the records go back to 1959. And also confirms that Australia has been in recession over the first half of this year, and we're not anticipating that we'll really see a recovery gain momentum until the December quarter of this year. We think in this current September quarter, we're likely to see a flat outcome for GDP, with the lockdown in Victoria and its spillover effects to the rest of the country just pushing the recovery out to the December quarter. What the national accounts data also showed was a massive jump in the savings ratio. So clearly, during the June quarter, household caution meant that households pulled back on spending and also tried to get their household balance sheets into repair. Now, when we talk about the economic recovery, we like to refer to an alphabet soup. So what's become very popular is to think about the recovery as an L, a U, a V or a W. So L is we're not going to get out of this pandemic anytime soon. V is a quick snap back to pre-crisis conditions. U is that gradual recovery, and W is two Vs together or a double dip recession. In our opinion, it'll probably be something like a back to front J. So it's a bit like a U, but it's just going to take quite a long time to get unemployment back down to 5% and to get economic activity growing at potential or long-term trend, which is around about 2.6% in Australia. We're a long way from that at the moment, with the annual pace of GDP down 6.3% in the June quarter. So we like the back to front J, and what's really critical to the outlook is consumer confidence, as well as business confidence, but particularly consumer confidence. And consumer confidence is going to depend a lot on how successful the government and health authorities are in suppressing the virus. And that will then help consumers feel more confident about the economic outlook. Now, in Australia, of course, the key lens is on Victoria and what's been happening with Victoria. With Victoria still got a few weeks to go before it gets out of lockdown. And what's really encouraging is if we have a look at the 7-day moving average on the number of new daily infections for Victoria, it has been coming down. So that gives us some greater confidence that perhaps Victoria will come out of lockdown as planned. Now, in New South Wales, we're also facing growing clusters, but so far that has proved to be quite manageable by the New South Wales government and New South Wales health authorities. Now, collectively, these two states account for 56% of output, and obviously what's happening in Victoria sends a reminder that the pandemic can change conditions very quickly, including changing rules, regulations and guidelines for businesses very quickly. And that just means that we are at the mercy of this pandemic until a vaccine materialises that is available commercially and also, I would say, worldwide. So what are the latest readings on confidence? Well, these two measures are among the most widely watched. Business confidence, the latest available data is for July, and that did show a pullback, but we would expect an even deeper pullback given that in August, Victoria did enter stage 4 lockdown. For consumers, we have the data available as at early August on this chart, and it does show a pullback in consumer confidence. And both readings are below the thresholds that suggest that in aggregate, consumers and businesses alike are more pessimistic about the future. For me, what's encouraging is if we have a look at a weekly consumer confidence survey, which is published by Roy Morgan, in the last 2 weeks, that's actually showed an improvement. Now, consumers are still pessimistic about the outlook, but that pessimism has waned. And I think that's got a lot to do with the fact that that 7-day moving average in Victoria has started to move down encouragingly. Now, consumer confidence will also be determined quite critically by the shape of the labour market and how consumers are feeling about their jobs, i.e. if I'm feeling confident about my job security, then I feel more confident about the outlook and I'm more likely to go and spend in the economy, which will help feed economic activity. In fact, today's data from National Accounts showed what actually drove that big drop in GDP was a very substantial drop in household consumption, particularly services, with the lockdown occurring in the June quarter. Now, if we have a look at the labour market, it's an interesting story. Over June and July, we've seen strong jobs growth, but the unemployment rate has still gone up. And in fact, in July, standing at 7.5%, which is the highest rate since late 1998. The underemployment rate more recently has also come off. However, it's still in the double digits. Now, the JobKeeper scheme has been a real game changer and it has helped minimise the rise in the unemployment rate. And something else that's helped minimise the rise in the unemployment rate is that drop in the participation rate, which means there are people not actively looking for a job or employed in the labour force. So it makes the unemployment rate look better than otherwise would be the case. So in fact, the participation rate lately has started to rise, but it's still at quite low levels compared to pre-pandemic. So what we expect over the rest of this year is that we do expect that unemployment rate to trend higher towards 9%. The Reserve Bank is more pessimistic. It sees it rising towards 10% and holding above 7% for the next 2 years. Now, the rate that's consistent with full employment in the economy is 4.5%, so clearly that's a long way from full employment in the economy. Now, as I said, in June and July, we did see some strong job gains. And in fact, the Australian economy recouped almost 40% of the job losses over May and April. In Victoria, of course, we'd expect jobs to be shed over August. But nationally, we are seeing a recovery underway, leaving aside Victoria, which will join that recovery once it comes out of lockdown. Now, the RBA is closely looking at unemployment, but it's also closely looking at inflation. And in fact, it adjusts its cash rate settings based on its expectations around inflation. Now, inflation in underlying terms has softened to 1.2% per annum in the latest available data. And in headline terms has actually turned negative, so it's actually contracting. Now, the RBA just yesterday met in terms of its board, and it published an accompanying media statement. And in that statement, it said it expects inflation to average between 1 and 1.5% over the next few years. So again, this is another indicator that the RBA closely watches and won't be meeting its target anytime soon. So you've got unemployment moving away from the target, not likely to get back down to 4.5% anytime soon. And you've got inflation that's very soggy and also not likely to be in the RBA's target band of 2 to 3% over time anytime soon. So that means the RBA is likely to keep the cash rate low for quite a long time, in fact, for at least 3 years. And the RBA governor has said it will not lift quantitative easing. And in Australia, quantitative easing takes the form of the RBA buying government bonds in order to target a 3-year government bond yield at 0.25%. So it's not going to lift QE until it sees some progress towards those targets, and it's not going to lift the cash rate before it lifts QE. So we know that interest rates are going to stay low for quite some time. But what more can the RBA do? Because it's quite possible the Reserve Bank needs to provide more stimulus over the year ahead. Is the RBA pushing on string? There is still more room for the RBA to do some heavy lifting. Yesterday, it announced an expansion and an enhancement of its term funding facility, which means banks can access cheaper funding through that facility, encouraging low lending rates in the economy. But the RBA might even cut the cash rate from 0.25% to 0.1%, or it might cut the 3-year bond yield target of around 0.25% to 0.1%, or it might extend the targeting to 10-year yield targeting. The RBA governor has made it very clear that it's extraordinarily unlikely that we'll get negative rates. What does that mean in a pandemic? It means that that'll probably be their very last tool, and they won't go there unless they absolutely have to. So it'll be right at the bottom of the toolkit. Interestingly, our New Zealand neighbour, the RBNZ, they are more likely to go down that route of negative rates than the RBA. The charts on the slide, you can see that lending rates have moved much lower, and that is helping provide some, resilience than otherwise would be the case in the Australian economy. Now, on the top of everyone's mind is always dwelling prices in Australia, so I really can't give a presentation without touching on dwelling prices. And we also received the latest available data on dwelling prices from CoreLogic yesterday, and that showed across the capital cities another decline for the 4th straight month as COVID-19 disrupts the housing market. We are seeing upward pressure on rental vacancy rates. We are seeing also downward pressure on rents, particularly as some Airbnb properties join the long-term rental market with immigration grounding to a halt. And also with households getting a dent on incomes. We know from the number of hours worked in the labour force survey that people would like to work more hours if they could. We also know that from the underemployment measure. But also the unemployment rate is heading higher. So the combination of those factors mean that dwelling prices are likely to soften over the remainder of this year and over next year, particularly in Sydney and Melbourne, although Sydney is likely to show more resilience than Melbourne, with Melbourne obviously experiencing stage 4 lockdown at the moment. When we've looked at past downturns in Australia, what we know is that the amount of stock that is available to buy usually drops in downturns, and this time is no different. So people will wait for a better time to sell their house if they can. And obviously that depends on mortgage stress, and that also depends on the labour market. Now, the banking industry has extended its mortgage moratorium to early next year, and interest rates are very low, but the unemployment rate is still steadily moving higher. So the housing market has to contend with those factors. So in that environment, we do expect that on average, dwelling prices are probably going to decline by between 3 to 5% this year on average, and next year it's likely to be in that 5 to 10% range. Now, something that is appearing or materialising in the housing market is that we're getting a bit of a divide happening. So that is, there are greater interest to buy homes in the regional areas of states, and also in states like South Australia that have had greater success with suppressing the virus, where homes are more affordable, particularly given now there's such a large amount of people that are working from home. And after the pandemic, it's quite likely that there will still be a large number of people working from home. So that's really changed, I guess, the demand dynamic in terms of where to buy a home. Now, something else that's been really fascinating, of course, is what's happening with equities, particularly in the US share market. We've seen the S&P 500 index make a new record peak overnight. We've seen the NASDAQ 100 index push through the 12,000 index. The Australian share market has also lifted considerably from its low in February of this year, but nowhere near to the extent of these US counterparts. Now, I've got to bring back the letter, but this time I'm going to bring back a K. So what we're seeing in the US share market is a K. And what I mean by that is, whilst you're seeing these headline share market bursts certainly push considerably higher, within that, there is a lot happening. And in particular, tech shares are going on the way up. Obviously, the way we work, live and learn in this pandemic has changed, and we're being propelled onto online spending platforms even more than ever before, and we're using innovation more than ever before. And in fact, businesses to survive this pandemic are changing their business models and changing the way they operate, and that has often involved innovation. So that's benefiting these tech stocks, which is helping to lift headline bursts. But then if you have a look at, for example, Boeing, it's still down from where it was at the end of last year. And that is because it is really at the coalface of this pandemic, with international travel grounding to a complete halt. So in terms of headline share market bursts, what is really happening? Is this just a detour and we're about to go down? Is it a bubble? Are investors not appropriately factoring into their models the fact that share markets are making new record highs, yet economic data, for example, in the US is still showing that the US economic recovery is very fragile and nascent at best? Or is it the case that there's just so much growth in money supply, with central banks and governments around the world unleashing considerable amount of stimulus, and interest rates are so incredibly low and investors are just chasing a return? Certainly, the share market, one could argue, with selective stock picking, offers a better return than, say, the alternative of interest-bearing assets. So before I wrap up then, I just want to take a quick look at the risks on the horizon. And you can't go past the number one risk, which is investors are factoring perhaps that a vaccine is on the way, and that, of course, is the end game. But we can't be certain that a commercially viable worldwide vaccine will be available anytime soon. So that is a risk that perhaps that'll be pushed back or won't materialise. You've got the ongoing US-China tensions, which are spilling over to some other countries. And then you've got the US election in November, which I think really is shaping up to be a moment of probably considerable volatility. Now, I think really one thing that we can be assured of until an end vaccine materialises is volatility. Now, volatility has come down from its peak levels at the height of the pandemic in March and April, but it's certainly a lot higher still than where it was pre-pandemic. And really, that is something we've got to be mindful of, that all asset markets will continue to be subject to considerable volatility over the next 1 to 2 years, particularly until an end vaccine, a vaccine is made available. Thank you for your time. I would just like to show you my disclaimer before I pass over to Melissa, and I look forward to the Q&A session.
Thank you for your economic views, Besa. Hi, my name's Melissa Darmawan and I'm a wealth specialist with DT. Over the next 20 minutes, we are going to discuss latest market insights and trends with two leading fund managers. Welcome Anthony Doyle, cross-asset specialist from Fidelity, and Chris Adams, portfolio specialist from Pendal. We've just heard from Besa her economic views. To get the discussion started, I thought I'd ask your thoughts on how to reconcile market outlook with the current state of investment markets. Thought I'd start off with yourself.
Yeah, certainly. Thank you. So I think, we've obviously seen, and, Besa outlined it all really well, I think, we're in a very uncertain environment at an economic level, and yet we've had these markets which have surged, and particularly in the US, are making new highs every day. We're at a higher level than we were pre-COVID. I think, people look at that and they get worried and they say that, people are living in this bubble. I think there is a degree of rationality to what's happening here. And again, it goes back to what Besa was saying in terms of alternatives that are out there. On one hand, you've got a huge increase in global liquidity as a result of what central banks are doing around the world. And that's looking for a home, and that's finding its way into economic markets. And on the other hand, with interest rates coming off, bond yields coming down, people are looking at the alternatives and weighing up and saying, actually, well, I want to be parking some more money in equities. So I think, from the overall fact that the markets are doing well, there is a degree of rationality to that. But then secondly, and again, to Besa's point about what's going on within the markets, which, as stock pickers is really interesting from us, you've got to recognise that impact of technology and the fact that it's really a very narrow part of the market which has been driving a lot of this growth. And indeed, that's been a key reason why the Australian market hasn't done as well as the US market, for example, where in the US, some of those large cap technology stocks are sort of 40% of the market, and we don't have those same kind of stocks here. Technology is a much smaller part of the market. So what you've got is a small part of the market which is shooting the lights out, but you've got a lot of stocks which are still languishing. And, many stocks which sort of went down, had a little bit of a recovery, but then have gone sideways since. And again, there is rationality to that. People are uncertain about these stocks that have been impacted by COVID, and they are putting their money where there is some more certainty around the earnings in some of these technology companies. But again, from our point of view, that's driving some really interesting opportunities, because you start to think through, well, how does this evolve? At what point does the market start to get more comfortable with some of these companies which haven't yet really, they haven't participated in this recovery?
And your view, Anthony?
Yeah, I'd echo Chris. I think that it's very difficult to reconcile what is going on in the real economy. And I think, people watching will feel that. I think a lot of us know people that are on JobKeeper or have had pay cuts or potentially lost their jobs. A lot of us are tightening our belts, as Besa said, tightening our household finances and, pretty nervous about what the outlook contains. And it doesn't really marry with what's going on in the stock market. And, in all actuality, shares and risk assets are being propped up by central banks. The Aussie equity market's being propped up by one of the largest stimulus packages from the federal government that's ever been seen. So, with that in mind, I think for Australians it's quite difficult to understand what's going on, but you have to remember that this is the central bank playbook. Essentially what they want in cutting interest rates to all-time lows, making the cost of capital cheap. They want you to borrow, they want you to spend, and they want you to take more risk with your investments, and that's exactly what is going on. And it's new for Aussies, but the Brits have been there for over a decade. The Americans were there, they had some success with lifting interest rates, but obviously now back at record lows. The Europeans have negative interest rates, the Swiss have negative interest rates, and the Japanese have been there for 30 years, which has led to the carry trade. So I think that for Australians, this is the world that we now live in. And as Besa said, it's very unlikely that interest rates are going to rise within the next 3 years. I would say the next decade, given the decimation that is occurring in the real economy, how unlikely it is that unemployment is going to get down to that 4.5% level anytime soon. And that might sound outlandish, but after the GFC, the Bank of England hadn't hiked rates for 8 years, and the ECB also had rock bottom low rates for 10 years, and the Bank of Japan for almost 20 years. So I think this is something that for Australian investors, they have to bear in mind that defensive portion of their portfolio will no longer assist them in generating those long-term investment goals through the eighth wonder of the world, compound interest. They have to start taking more risk if they want to make those long-term total returns. And that starts to mean thinking about potentially different asset classes to what they're used to.
Very interesting insights from both of you. In Australia, it's been reporting season, and I'll be keen to hear one or two insights from either of you that you can share with us. I'll start off with you, Chris.
Yes, so I think the key thing from our point of view, it sort of really emphasised the degree of dispersion and differentiation that's going on within the economy. and just, you know, turning people's expectations on their heads in terms of companies that, you know, at the end of last year, you would have considered very defensive in an economic downturn, proved not to be defensive just because of the idiosyncratic nature of this downturn. And then likewise, which companies where you would have said, you know, if we'd had this kind of environment, would have been absolutely smashed, but have done, you know, very, very well. And, you know, I'm thinking of companies there like, you know, infrastructure companies, normally considered defensive, but all of a sudden if traffic numbers halve, not so much. And then likewise, on the other hand, you've got companies like JB Hi-Fi, you know, consumer electronics, and typically if you had an economic downturn, you would expect that to be impacted very negatively, but the exact opposite has happened, obviously, because of everything that's been going on. So it's really turned expectations and people's views of relative safety in the market on its head. But there was certainly there were signs during reporting season of a number of sort of unloved industries and unloved companies where people started to get some sort of sense that maybe we've seen the worst. And they reported results which were obviously reflected a really poor half, but where people were saying, okay, we've probably seen the trough now. And so you saw, you know, good share market performance from companies like sort of Nine and Qantas and Reliance, where there's been a big impact, but they've started to turn the corner. So that was one key sort of takeaway from us, is that sort of sense there that people are getting a little bit more comfort that we're going to start to see a gradual improvement from.
And Anthony, your views?
Yeah, so I think most have been pleasantly surprised that things weren't as bad as what we had anticipated. So around a third of companies have reported an increase in earnings. Normally it's around 2/3. But obviously we've also seen a lot of dividend cuts. And as I mentioned, whilst most companies won't acknowledge it, a lot of their staff are on JobKeeper. So the taxpayer is directly supporting potentially dividends that have been issued. So I think that with over $200 billion of fiscal stimulus in terms of JobKeeper, et cetera, assisting companies through this very difficult period, which is exactly the right thing to do, we shouldn't get too carried away. And with that in mind, you know, we should be thinking about the real winners and losers, both at a country level, company level, and even within sector level, in order to truly try and comprehend where the potential opportunities lie, because we are still very, very early in this crisis. If you think about at a micro level, you know, a consumer that's finding it difficult to pay back credit cards or their mortgage, et cetera, to a company level. And I think that this is something that we should watch very, very closely, and that's something that we're doing, you know, in terms of our conversations that we have with companies and company management.
Yeah, thank you for that. With interest rates so low, both here in Australia and overseas, the search for income is quite challenging. What does that mean for investors and their portfolios? I'll actually start off with you, Anthony.
Right. I'll steal a march on Chris. So I look at cross assets, and yeah, as I said, if you're trying to generate a positive real return, which means when we account for inflation, despite Besa articulating that the RBA is expecting, I think it was 1.25% to 1.5% inflation over the next couple of years. The yield on government bonds and investment-grade corporate bonds, investment-grade corporate bonds are about 1.5%. The Aussie 10 years around 90 basis points, so 0.9%. You're actually going backwards in real terms. So I feel sorry for those that are trying to generate an income, whether that be from the major banks or Australian equities in terms of dividend cuts that we're seeing, whether that be from residential property investments, whether that be from the defensive portion of their portfolio in terms of fixed income instruments. So it's hard. It is difficult. But that said, as there are winners and losers from this current great lockdown crisis, and clearly tech's a big winner. Clearly healthcare is a big winner. Gold has been a big winner, gold mining stocks, for example. So there are opportunities, I think, for active investment to identify those companies that are likely to thrive and get stronger on the other side of this crisis when we do eventually pop out of it. Because what they'll find is an operating environment where there is less competition and they can grow their earnings, grow their revenues. And obviously a lot depends. This is a very unusual recession, one that many that are alive today have never experienced. I don't know if there are people back in the Spanish flu type era, probably not. But for us, we have to think about we're being dictated to by COVID. And Besa alluded to earlier, the Northern Hemisphere is going into winter now. 90% of the world's population reside in the Northern Hemisphere. We're coming into summer, obviously, thank goodness. But, we should be highly cognizant that any sort of second, third, fourth wave without a vaccine, which is very difficult to formulate, we'll see further restrictions on economic activity, growth, and therefore that will feed through into company earnings, for example.
And your view, Chris?
Yeah, I think if you look, specifically within Australian equities for income, which increasingly a lot of people are doing, given the comments around bond yields and interest rates, again, it's just this sense that things have changed and people's expectations have changed or have to change from where we were a year ago. We've had an environment where many of the big sectors where you can historically have depended on a dividend have seen those dividends either disappear or be cut significantly. We've seen that from the banking sector. We've seen that from a lot of the utilities and infrastructure sectors. And companies which, going into this environment, which people held because of that defensive nature and the relative dependability of that dividend income, and it disappeared. And what you've got instead is you've still got parts of the market where it's possible to get really good dividend yield, but they're changed. Where we saw actually increases in dividends in the last sort of half or so has been in places like retail, where as a result of all the stimulus packages that we're getting and a lack of alternatives to spend it on, you can't travel overseas anymore. People have been buying up big in retail. So retail has been going very strong and retail companies have been paying good dividends. And of course, resources is the other area. We've got an iron ore price which, was getting up to $120 US, and nobody expected that a year ago. And so again, you're getting huge amounts of cash flow and dividends out of resources. So it is still possible to find areas in the market where you can generate income from equities. But at the moment, it's perhaps different from where you might have gone a year ago.
Interesting insights from the both of you. So this is our last question before we move on to the questions in Slido. And this one is around ESG, so environmental, sustainable governance investing, also known as sustainable investing. And ESG considerations are starting to become more mainstream these days. What does that mean for investors? You know what? I'll start off with you now, Chris.
Look, I think ultimately the increased focus, which is becoming more and more mainstream on ESG factors, will lead to better quality companies, or a push for better quality companies, and ultimately that should lead through to shareholder return. And I think of good examples recently. What happened with Rio and the Juukan Gorge. I think the way that the company has communicated around that, the way that it has conducted the review of that, has been less than ideal. And what you're seeing is a lot of, despite the fact that the parliamentary inquiry has been completed and the board-led review has been completed, the noise around that isn't going away, and the pressure from shareholders is not going away to say that actually we don't think the company appreciates the gravity of what's happened, and actually the questions it raises around your sort of corporate governance and accountability and those sort of things, but also just the view of the broader market and investors about how companies should be run. And so these kind of issues, I think, are generating more scrutiny and more shareholder pressure, and we're seeing that in increased activism, across the board. And ultimately that should lead to better outcomes and better cultures, I think. But the key part there, is I think, the role that we play as sort of stewards of capital and active investors who manage reasonable amounts of fund, and our ability to, get access to high levels of management and to the board, and to really be pushing these kind of issues, I think is really, really important part of that process.
And Anthony, your view?
Yeah, just to echo Chris's sentiments, I mean, the investment management industry is really responding to the demand from our clients for better outcomes and better sustainability outcomes. So you've seen a large number of investment managers sign up to the UN PRI, Principles of Responsible Investment, or try and assist in allocating capital to develop the UN Sustainability Development Goals, for example. And it's something that we think is here to stay, definitely, and will grow. And ultimately, what we've found during the crisis in terms of a study of the companies, so we rate every single company that we invest with on a sustainability score of A to E, independent of credit rating agencies. And we found that those companies with the better scores performed better during the drawdown during March, for example, and the volatility during March. So we ultimately want to work with companies in order to improve their sustainability ratings, which should ultimately drive shareholder returns higher. So to give you one anecdote, I was in Shanghai last year and I met with one of our China equity analysts, and he told me that there's 4,000 companies on the Shanghai and Shenzhen stock exchanges, but when you screen for governance issues, it comes down to around about 500. Thinking about who the auditor is, is it someone's mate down the road, and you start looking into supply chains, start looking into working practices. So I think it's undeniably a good thing. We have, fund available, a sustainable water and waste fund, for example, on the Panorama platform that we launched, I think, a couple of months ago in response to this. And we think that ultimately it will be incorporated in all funds, and it won't be a distinct asset class, but this is a way that is an appropriate way to drive shareholder returns over the course of the long run.
Great. Thank you, both of you, for your views. All right, so we're now going to make our way to the questions on Slido. If you have any questions for either Chris, Anthony or Besa, please enter them on slido.com #VT2020. So we'll welcome Besa back onto the stage now to open up for questions. All right, first question is actually for you, Besa.
Oh, great.
The Australian dollar has bounced from US 59 cents in March to over US 70 cents. What are your views on the Australian dollar?
Well, look, I think the Australian dollar has some momentum behind it, and that it can rise a lot further from here on out. So we've actually seen the Aussie rise from a March low of 55.1 US cents to a two-year high overnight of 74.13 cents. And what I think is that the Australian dollar has now completed the downward trend that began back in April of 2013, where it was at $1.0582, moving down to 55.1 US cents. And I think it's completed that downward trend. And now I think the key test really comes at this 74.5 to 74.8 US cent range. And what I mean by that is that range represents the 38.2% retracement of that downtrend. And I'm looking at technicals much more closely than I ever was, partly because we are in a period of high volatility, as I ran through in my presentation, and the technical analysis just provides that bit more in volatile times. So I believe technically, if the Aussie dollar breaks above that level quite cleanly and quite quickly, then we could well be eyeing 80.5 US cents quite quickly. And then we'd be looking to 86 US cents over the next 12 months. So that's a real test. On a fundamental basis, Chris was talking about iron ore prices being quite elevated, and they certainly are. We've got infections ravaging Brazil, which is another big producer of iron ore, and that is also disrupting their mining production. And as a result, that is keeping iron ore prices elevated. But also you've got China, which is our biggest trading partner, undergoing what is looking like a very V-shaped recovery, at least so far as industrial production is concerned. Retail spending is probably more of a U-shaped recovery, but certainly China looks out in front compared to other major economies around the world, and we feed into that. And then if you consider our suppression of the virus, even taking into account Victoria, we've suppressed this virus among the best in the world, really. We can join the likes of China, Taiwan, New Zealand. Sure, our record might not be as good as, say, New Zealand, but it's up there, particularly when you compare it to the United States or the United Kingdom. And then if you look at our economic growth outcomes, for the June quarter, GDP contracted by 7%. That's a lot better than India at down 25%. It's a lot better than UK that was down by more than 20%. And it's a lot better than Europe, and it's a lot better than the US. So I do think the Aussie dollar has more potential to rise from here on out against the US dollar.
Thank you for that, Besa. This question's for you, Anthony. So, Anthony, you mentioned you mentioned something around other asset classes. What are the best other asset classes for investment purposes?
Yeah, so when Australians are thinking, well, there's no best asset classes, but obviously, we have a view on where the potential value lies in international equity markets in particular. So remember, the Australian equity market is 3% of the global market, so a very small cohort of a plethora of opportunities in the equity universe. So our favourite area today is Asia, Asian equities. Besa mentioned the good experience that China has had in suppressing the spread of COVID-19. They have less daily cases than Victoria now, for example, a country of 1.3, 1.4 billion people. Chris alluded to people staying at home and spending at home, and that's exactly what the Chinese are doing as well. So we've seen an acceleration of trends that we're seeing in the Western world exist within China and Asia in terms of people moving online. We're seeing people travel domestically within China and increase spending on domestic services and items. So we're seeing an acceleration of these long-term trends of rising wealth and superior demographics across Asia. So we really like Asian equities where we are overweight. And in terms of emerging market equities, again, to get into, delving into some of the market specifics, Chinese equities have actually outperformed American equities, US equities. It has a similar weighting towards tech. So around 19.5% of the Chinese equity index is tech. But when you look at other emerging markets, for example, EMEA is 0 and Latin America is 1.5%. So if we do see some sort of global economic recovery, synchronized growth cycle, commodities are likely to pick up, and those regions of the world may indeed do a little bit better as well. So Asian and emerging market equities, Australians are historically underweight or don't have zero exposure to this part of the region, fastest growing part of the world, and that's one place that I think that Aussies should have a good hard look at going forward.
Thank you for that. So I'll open this question up to the panel. When COVID first hit, there was a talk of a double dip on the share market. Do you think this will happen again? Thoughts? So,
look, I think there's always the risk, and there are plenty of factors out there that contribute to that risk. We're seeing a second wave, obviously, material one in US, much smaller here, but we're seeing numbers pick up in Europe as well. And there's questions about the ability to manage that. Now, it looks at this point in time through a combination of different age cohorts, better understanding of the virus and how to treat it, widespread testing. We've had some better news or some new news this week around new testing kits, which can give you a response in sort of 15 minutes and should help in that regard. There's enough going on there that it feels like we can manage a degree of COVID in the economy without reverting back to the shutdowns. However, if that was to prove not the case and we saw material shutdowns on a widespread basis, which then saw the economic recovery stall and peter off, we could see that reflected in share markets. US elections, geopolitical tension, there's a whole number of different areas where risk could come from that could see markets come off again. But for us, the big thing is the degree of policy support. We think that helps underpin markets at their current levels. So whilst ever central banks and governments around the world are basically saying we will do whatever it takes to backstop the economy, for various different reasons, we think that can help support markets at the current levels. But, to go higher from here, you will probably need to see some higher from here in the near term, some sort of, material news on a vaccine or something like that.
Yeah. Anthony?
Yeah, I think the greatest risk to the equity market today is the federal government removing policy stimulus too quickly. So we'll be watching, as best we will, I'm sure, on the 6th of October, the federal government, the budget will be announced on the same day as the RBA meeting. Because essentially what we're doing is trying to steal growth from the future to plug into this huge hole that we have today. So I would hope that that budget would continue in terms of stimulating the Australian economy, particularly as it's so cheap to borrow from bond markets. So I hope they don't get too caught up around concerns around AAA credit ratings and so on and so forth, because it's never been cheaper for the Aussie government to borrow long. And surely there are investment projects that will help the productive capacity of the Australian economy and support this recovery going forward that yield over 1.5% for 30 years. So I think that's the greatest danger. But at these very ultra low interest rate levels, investors in Australian equity markets have to get used to higher volatility. So we're going to see drawdowns. Once upon a time, we might have seen a drawdown of 10% every couple of years. We might see them a lot more frequently now. And this really speaks to having a long-term time horizon in terms of your investments and diversification. So whilst the defensive portion of your portfolio won't do a job for you anymore in generating total returns, it will definitely help you in drawdown type scenarios, in minimising the volatility that you're likely to experience. So bear that in mind as well, whether it be cash or government bonds, for example.
Thank you.
I certainly think no one was anticipating a pandemic, so we certainly can't rule anything out in this sort of environment where we still don't have a vaccine. But I do agree with Chris that we've probably seen the worst behind us, or at least the trough behind us, conditional on no sort of third or fourth waves, I guess. I also think, as Anthony highlighted, that it is quite critical that stimulus not be withdrawn too early, because that would be a policy mistake. I think as a percentage of GDP, the government debt is still pretty low compared to other major economies. Global government bond yields are very low, so it is very cheap to borrow. State governments, as a percentage of their economy, haven't delivered as much stimulus as the federal government. So there's still more room to go, I think, if certainly the economy needs it. And whilst the RBA can do a bit more, as I outlined in my presentation, I think it's really on the onus for the federal government to do more, because that's where more stimulus can really be provided. And that might be in the shape of some very quick infrastructure projects like shovel-ready projects, or maintaining assets, as well as considering perhaps extending some of the key support measures like JobKeeper, which is due to end at the end of March, but that'll probably be too soon for it to be to end in full, given that economic activity by the end of March will still be most likely on a fragile footing.
Thank you, Besa. Last question. With the level of central bank support globally, do fundamentals matter anymore? So that'll be a question for the panel. Chris?
Absolutely is the short answer, and I would argue fundamentals, certainly in the way we view them as being, understanding what's happening at an industry and company level within Australia, matter more than ever, because we really are seeing sort of the sorting from the wheat from the chaff in terms of the ability for companies and management teams to get their head around the change in the world that we've seen, and we've seen, acceleration in things like online spending, things like that, where changes that were expected to take place over 5 or 6 years have been compressed into 6 months. And some companies have just proved themselves better able to get their head around that and adapt than others. And so for us, actually getting in there and understanding, how are companies adapting to this? How are they firstly adapting to the current environment that we're in, where they might be seeing a dramatic reduction in revenues or a dramatic increase in revenues? How are they adapting to that? But then secondly, how are they then thinking about this in 1 year, 2 year, 3 years and beyond? And the better quality management teams are starting to tell us, okay, we're living in a different world now. This is how we're reconfiguring our business to adapt for this. And ultimately, we believe that will come through in differentials in share price returns. So for us, at the way we view fundamentals, we would say that They're more important than ever, and that ability to be very discerning in which stocks you want to own within the market is incredibly important for investor return.
Thank you. Anthony, your view?
Yeah, I mean, I agree with everything that Chris just said, but I'll give you a reason. I'll just take the other point of view, right? So I totally agree, but let's say they don't, right? Let's say that fundamentals don't matter anymore. Why is that the case? Well, we know that central banks are doing unprecedented amounts of monetary stimulus. Interest rates are at all-time lows, and investors are being herded into riskier asset classes like equities or even high-yield corporate bonds in order to generate positive real returns. And this is exactly the central bank playbook. So if you think that interest rates remain low for the foreseeable future, if you don't think there's some large inflationary shock to force them to raise interest rates, and if you think that we're going to continue to see investors like institutional investors, pension funds, SMSF investors, retail investors continue to rebalance their portfolio in favour of riskier assets, well then fundamentals don't matter. So if you're looking back on this event in 10 years' time, risk assets are probably going to be much higher than they are today because of the huge amount of monetary and fiscal stimulus that we're seeing. So own something. Own a house, own investment property. If you like Chris, own fine wine, own fancy art, own gold, because the experience post-GFC was inflation, consumer price inflation was very low, but financial asset inflation was very high. Own something. Long bonds, equities, it didn't matter. And it's not just Aussie investors in this environment, we're all in it together now. And with that in mind, as I mentioned, you can get caught up in the day-to-day headlines of movements and what's Tesla doing and what's Alphabet doing, etc. I think stick to your plan, diversify, have a long-term time horizon, and enjoy your retirement on the beach, walk around and, walk the dog, play with the grandkids and things like that, and not get too caught up. Because at periods of volatility, investors' time horizon goes from very long to very short. So with that in mind, you obviously have to have enough capital to be liquid and think about deploying it at times of drawdowns, because central banks, that's their playbook. That's exactly what they want to happen.
Good one. And Besa?
Well, I'm an economist, so fundamentals always matter, particularly over the medium term and long term. I guess what I would just say is that it's clearly the case that uncertainty is higher than ever before, and that does make forecasting very difficult. So it's not just fundamentals that matter, but really the underlying fundamentals. And so you've got to put a closer lens on what's happening at the industry level, what's happening across the state level, what's happening across the sectoral level. And I have to agree with both Chris and Anthony, selective stock picking, diversification, they are very critical in this sort of environment.
Thank you, Besa. All right. I do want to say thank you to Besa, Anthony and Chris for your time today. I found that very valuable, and I hope you did too. That's all we've got time, and now I'm going to pass it back to Paul.
Thanks, Mel. So in closing, I would like to thank Besa, Anthony and Chris for delivering their timely insights. I've really enjoyed it, so I hope that people have got something out of it. You will receive an email from us with a replay link. Also, we had lots of questions that came through, so if we didn't get to your question, please use the email address that we've got up there and we'll look to try and answer your questions. Again, if you would like to find out more about some of BT's solutions, please contact us at that email address as well. So thank you very much. I hope you have an enjoyable day and I hope you've enjoyed today's presentation. Thank you.